Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about LEAPS. LEAPS, long-term equity anticipation securities. Now, it sounds really fancy, but these are just our regular old puts and calls that we're buying and selling, but we have a long time till expiration. That's about the only difference, but there are some perks to these, so we'll talk through that. So, you want to learn about LEAPS? If that is what you're looking for, please stick around. Whoop. So LEAPS, we can certainly call the acronym police on this one if we would like to, but it does make a lot of sense because we are leaping out into the future, 1 year, 2 year, even 3 years into the future and trading these options. And what's the perk of that? Well, if we open up a contract right now and we hold it for over 366 days, by the way, I'm not your tax advisor, but we'll qualify for long-term capital gains. So if you open up it now and you make profit and close it in 366 days, in that tax year, you're going to pay long-term capital gains versus what we typically pay like ordinary income on short-term trades with options. So that could be a nice perk for people that are looking for tax efficiency, which if you watch my last video, I'll link up above, that's what that was about. So I'm kind of continuing this idea. So how can we translate that over to options? So we'll look at that, talk about that, and look at a bunch of different strategies with this, because I think if you're new to options, still learning about buying and selling puts and calls, this can pull some of that information together for you and tie some things up nice with a nice little bow. So let's look at some examples. So let's start out by talking about NVIDIA. Love it or hate it, there's lots of passion when it comes to NVIDIA. So are you an NVIDIA bull? It's going through the roof. Are you an NVIDIA bear? This thing is way overpriced. Whatever your stance is, I'm sure you have feelings on one side or the other. And because it's such a popular stock right now, there's going to be lots of options available on the option chains, lots of volume, lots of open interest. So my first point with LEAPS is you need something that is going to have lots of option contracts and lots of expiration dates that go out beyond 1 year. So with NVIDIA, right now I'm looking at December 19th, 2025, but if I take that drop down, look all the way down here, it goes all the way out to January 15th of 2027. If we start talking about some podunk stock I've never heard of, it's unlikely going to have an option chain this expansive. It might only go out the next 2-3 months and have anything on there. It might be very difficult between that bid and ask price. But this going out about 14 months right now, we still have a bid and ask that's fairly reasonable, right? That we could execute this with. So first of all, when you start looking at LEAPS, look for popular stocks, well-known stocks, or ETFs. There's plenty of ETFs that offer LEAPS as well to work with. So in this case, we're going to be using NVIDIA as our example. So for this first one, let's look at buying a call option on NVIDIA. The classic buy a call directional bet. I'm bullish. It's going to the moon over the next 14 months. And, with 14 months until expiration, you can start to convince me, right? If you say NVIDIA is going through the roof over the next 1 month, 2 months, 3 months, there's so many variables. I don't believe anybody can really do that. It's very, very difficult unless you know something. But as you go out 1 year, 2 year, 3 years, I can start buying into this idea a little bit more, right? That with time, we believe that this is undervalued and it's going to reach its full value. You might be able to convince me as we go out with more and more time. So that's another thing with LEAPS. We have more time till expiration. So we have a better idea of where this stock could potentially be based on our valuation. So I picked a strike price of 145. That's at the money, just to get the conversation started. And so that'll be around a 50 delta, right? And if we did this at market, that would be $3,320. Pretty expensive. It is a volatile stock. It's going to be expensive to buy a call option with this thing moving all over the place. So that's going to give us a break even of 178.15, which would just be the 145 plus 33.20, right? Around 33 bucks, okay? So that'll give us our break even. Now, a lot of people are going to approach this and say, I hope that happens. Great. If it's well above 178 at expiration, I'll make money. But I know earnings are coming out in November, and maybe we'll get a nice big spike, and I'll close this out then and take the money if that presents itself that way. So you can approach this in different ways. But that's kind of the setup for this first trade. So the next point that I want to make about this particular trade is really important for those that are new to options. It's an important concept that you should understand if you're not familiar with this idea. And that is we have choices with our money right now. So if you've been following along, I talk a lot about maintaining cash and then doing option trades. So we have choices. So let's say we've got Finance Bro number one and Finance Bro number two. My son's in college. He hangs out with the Finance Bros. So why not compare these two guys? They both worked all summer and they pulled down $14,200 a piece. And they have this money and they're trying to decide what to do. And Finance Bro number one says, I'm going to buy 100 shares of NVIDIA stock for $14,154. He says, I'm going to make so much money over the next 10 years. It's going to be great. Finance Bro number two says, well, I took that class on options over the summer. I have a different strategy and a different theory. He has a choice, right? So he takes some of his money instead of all of it, and he plugs down $3,320, and he buys this particular option. Or maybe even goes higher on the strike price, way out of the money, just a winger, right? And he spends like $700 or $800, right? So that in that case, if he spends $700 or $800, he still has the majority of his money sitting in cash, earning interest. That is sitting over there in a money market account, right? So over that next 14 months, he's liable to pull in about $500-$600 or about the cost of that option. His option is essentially free while he protects his basis. The other guy has risk. This might look like it's risky, but he has a bet on NVIDIA over the next 14 months that this thing's going to go through the roof. And if he's right, he keeps his basis and he makes money on this call option, right? So there is risk reward with this, and we have options. So when we have higher interest rates, we have call options that cost more. And that's because of this kind of thing, right? You can either be in cash or you can be in an equity like NVIDIA. So it's important when you start looking at this, especially these long-term options, about what you're doing with your cash. I'm not saying you should do this. I'm just saying be aware of where your cash is sitting. Is it earning money sitting in a money market? Is it locked up in an equity? If it is, you need to make sure those equities are performing. Now, with this type of trade, I typically won't go out of the money or even at the money, and will go very deep in the money. My analogy for that is if you want to go way out of the money, like Finance Bro number two, and buy something very cheap, you can go that route, but your break even is going to be extremely high. And it's like trying to hit a home run. You can still get price movement early on through an earnings report, and you can do well and jump in and out. I know that. But if you go deep in the money, it's more like you're trying to bat for singles and doubles. So that's usually my approach. And that works out well for me and for people like Nancy Pelosi as well. That's right. Former Speaker of the House, Nancy Pelosi, loves this type of trade between her and her husband. They've done quite well. They defeat the S&P every year. I don't know where they get their information from. You'll have to let me know. Now, she's a congresswoman. She's adamant that it's okay. I'm not so sure. Let me know what you think down below. But made a pretty good move here back in November of 2023. On November 22nd, they bought 50 call options with a $120 strike price. Don't forget, we had a 10-to-1 split. So that means they have 500 call options with a $12 strike price that expire out here December 20th, 2024. So based on those numbers, it looks like those are now worth about 6.6 million, maybe up around 4.8 million. Not a bad day at the office. Now, they are worth about $200 million. I don't know, again, when it comes to politics, don't just tell me who. I hate all that stuff right now. We got this election coming up. I don't like either one of them myself, but I don't talk politics on this channel, so you can't ask me. So all I'm going to say is tell me the damn rules so that I can play the game. That's where we go. And I did see this sign today when I was out walking with my wife. So I guess maybe I'm just pro Wu-Tang Clan, but it did make me laugh pretty hard. Now I want to show you another trade here where we're going to be a seller of options. You can certainly use these and go and sell options just like you would buy shares and sell a covered call. So we're going to imagine that this time. We're going to sell to open one call option. Let's use the same expiration. And what I actually did, this is a trade that I just did this week. So yeah, I do these types of trades. I sold a 160 call option. So I've already done pretty well on these 100 shares. I bought them a while back. So I have a nice gain there already. So I'm selling a call option. And by going out to December 19th, I can generate a pretty nice premium, right? About $2,700 as it sits right now. I think I did this trade Wednesday, Thursday. And you can do different things here with multi-leg options as well. So if I wanted to keep these shares and just take a little bit of credit, you can still do this as a call credit spread, right? You could go sell to open, then you could buy to open, one call contract. You could pick that same expiration. Again, we're just having fun here with options. And I think, to help get concepts in your mind worked down, sometimes it does help to do this. So just as an example, if you just wanted to take out and create a little bit of a dividend for yourself with NVIDIA, you could do that. You could sell a 160, you could go out and you could buy a 170, and you could net out a credit between those two, right? Net credit looks like you get about $300. Now you have the potential of losing about $700 on this trade, right? Between those two strikes, there's $1,000, but you're taking in $300 of credit. So you can lose on these types of trades, but just again, trying to conceptualize what you could do with something like this. So did I do this? No, I didn't. What I did is I sold this 160 strike price. And again, I'm long some shares of NVIDIA. I think that's important to understand. So I've got 100 in this account. That's all you see. I have another 120 or so in another account. And I've got some in a retirement account as well. So I still look at myself as long NVIDIA stock, but I'm trying to take in some credit in this case. So I have sell to open, one call 160, took in that credit. And then I also sold to open one put contract, same expiration, and I went all the way down to 80. So think about the spread, 160 all the way down to 80. So 80, quite conservative, not a whole lot, but another $455. So net credit, net amount, you're going to bring in around $3,200 in this case. And if we stay between those two strike prices, nothing changes except I keep those $3,200. So pretty conservative on the put side, pretty aggressive on the call side. So if you're going to say I'm a betting man, do I think it'll be worth more than 160? I'd probably say likely, but I'm okay to give up the shares in that situation. So this can be something else you could look at, taking in some credit, being conservative on one side, aggressive on the other side, how you want to do it. But when I run the numbers on this, I want to say it's about 3.5% or something on this side. On this side, it was like 16 or 17% annualized rate of return. So blended pretty good and kind of hits my particular goals. So if this goes to 170, 180, will I be sad? Probably a little bit. But that's not too terrible because I'm also getting the gain from 141 up to 160, including the $3,200 of credit. So it works out pretty well for me in that particular situation. Now, I have had a situation like with JP Morgan. I did something like this, and the thing just took off, right? It was looking good at first, and then it just took off, kept going up. So I lost the shares, and I missed out on huge gains. So be prepared for that. So think about all the different things that could happen. If it takes off, am I okay with losing these shares or closing this option? If it tanks, am I okay picking up another 100 shares at $80 a share? So get comfortable with the idea and where the numbers are headed. And in this case, I thought that makes a lot of sense. Preview order, place order, and I'm off and running. And maybe I'll update you in about a year, and I'll let you know how it's going. For our last example, let's look at something a little bit different. In this case, it's TLT, and I do have 450 shares of TLT currently in my account. It's trading at $92.14, and this is the iShares 20-plus year Treasury Bond ETF. I think this thing was all the way up to about 180. It's been down as low as 83, and right now it's sitting around 92. So the expectation is as interest rates are reduced over the next year that we should see a nice little pop in this particular product. But after the first cut, the long end of the curve hasn't cooperated quite the way they expected, and we're kind of seeing this. It went up to about 100 or so. Now it's back down to 92. I do own some shares, and I've done a video, I'll link that up above, but basically trying to play ping pong with this, right? Kind of wheeling TLT, and you can do this with leaps as well, and I think it can be quite effective. So if you go and you sell out of the money, as you get more and more time till expiration, you can sell out of the money and get some decent returns. I'm kind of thinking about this for people that are in bonds, want to play around with bonds, still get a nice little bit of a return that they can use for income and retirement, but kind of like utilize options to maybe enhance that a little bit. So there are products out there like TLTW that offer a very nice return as far as the income that's spun off from those, but effective overall return is what I'm looking for here. So In this case, it's TLT. And again, if I want to just sell to open a simple put, and I go one put contract, and again, let's just stick with our theme here, which is actually looks like, yeah, there is no December expiration, so we're going to go out to 2026, which again, if we ride this all the way out till assignment, can work out pretty well for us if we're looking at it from a tax perspective, because we're going to kick that gain into 2026. Might be a smart move for us, right? So again, this has only been down to 83. So let's say we go with $86 strike price. And just to, again, set the stage here, let's go with market. We would collect around $370 for selling this put, okay? So again, we're not spending the $9,200. We're just putting a put contract into our account. We're going to keep this in cash, making 4.5% right now. Let's say they do cut rates a little bit. It goes down to 4%. I would expect TLT to rise up a little bit, but we'll see. And we're collecting 4%, let's say, because they cut interest rates a little bit. And if you run the numbers on this and you annualize that $370, when I looked at it, it was around 3.5%. So 4 plus 3.5, we're looking at a 7.5% return. We're also looking at long-term capital gains versus short-term capital gains for the option income. So does that kind of become interesting to you? Because if we get assigned 100 shares at 86, and when we sold this, it was at 92, which is about 6 points away. If we think about the low so far is around 83 when we had peak interest rates, and now they're on the decline, are we going to see something much lower than 80 in TLT, the long-term treasury bond ETF? I would say it's not likely, but it could certainly happen. So that's about 6 points away. So if it drops to 80, what I'm trying to get to here, and you decide to turn around and sell another call, about 6 points away, you should be able to get something close to 370. Maybe it'll be a little bit more, maybe it'll be a little bit less. Spitballing, ballpark number, something around there, right? So you might be able to continue with that rate of return being in TLT, which pays around 4% on an annual basis versus being in cash. So how would that play out for you? And by doing this, you're kind of buying time in your cash account in a lot of ways, right? You're buying time until maybe we have a correction in the S&P 500. We drop 25%, and then you can move out of this type of trade with some of that cash and back into something more lucrative. So while this isn't highly lucrative, I think for retirees and people that are looking around for options with their cash to create a little bit more income, this could be something worth exploring. So those are just some examples of leaps and how I like to use them, but explore it yourself. Don't listen to me. I'm kind of an idiot.
Years later, a doctor will tell me that I have an IQ of 48 and am what some people call mentally retarded.
But let me know how you like to use them, and if you've ever tried them before, if you have any questions, any of that kind of stuff, just ask me down below and I'll be sure to get back to you. If you like this type of content, please like and subscribe, and we'll see you next week. Take care.